Ray Dalio told CNBC the United States is heading toward a debt spiral. Not a recession, not a correction, a death spiral. That's the term he used. The kind of spiral where the government has to borrow money just to pay the interest on the money it already borrowed. Japan's been there. Greece lived through it. But America, we're supposed to be different. Except we're not. In 2025, while the S&P 500 returned 17.9%, gold returned 67%. That's not a typo. 67%. The best year for gold in 46 years. Central banks around the world now hold nearly 20% of their reserves in gold, up from 15% just 2 years ago. Poland is targeting 30%. China has been buying for 13 consecutive months. When you see what they know that retail investors don't, you'll understand why your dollars are losing value in real time. My name is Alex, and I've spent the last decade tracking commodity cycles and central bank policy so you don't have to. I read Federal Reserve reports and Treasury filings and IMF data releases because somebody has to translate this stuff into English. And right now, what I'm seeing in the numbers is something I haven't seen before. If you want to understand what's really happening with your money and why traditional advice might be failing you right now, make sure to hit that subscribe button and give this video a thumbs up if it helps you make sense of the chaos. Before we dive in, I want to know, what's your gold price prediction by end of year? 4,000? 5,000? Higher? Drop it in the comments. I'm genuinely curious where this audience stands. Here's what we're going to cover. The mechanics of how a death spiral actually works. Why gold is outperforming every traditional asset by margins we haven't seen in half a century. And what Ray Dalio, one of the most successful investors in history, says you should do about it right now. But more importantly, we're going to talk about why this is happening now, what it means for your purchasing power, and why the people managing trillions of dollars are moving their money in ways that directly contradict everything you've been told about diversification. Most people think government debt is just a big number that doesn't affect them. That's the trap right there. Because when a government enters a debt spiral, it doesn't just hurt the government, it destroys the currency. And your savings, your paycheck, your retirement account, they're all denominated in that currency. So when Dalio says we're in a spiral, he's not talking about Congress, he's talking about your wallet. Let me show you how we got here, because the setup matters. The United States national debt hit $38 trillion in October 2025. $38 trillion. That's a number so large, it's almost meaningless. So let me make it meaningful. In fiscal year 2025, the Treasury paid $1.22 trillion just in interest. Not paying down the debt, just interest. That's more than the United States spent on defense. More than it spent on Medicare. The interest payment alone is now the second largest line item in the entire federal budget. Here's where it gets worse. To pay that interest, the government has to issue more debt, which means next year's interest payment will be even higher, which means they'll have to borrow even more. That's the spiral. Borrow to pay interest. Next year, borrow more to pay higher interest. The year after that, borrow even more. And at some point, the market looks at that cycle and says, wait, how does this end? And when the market asks that question, bond yields spike. And when bond yields spike, the interest payment explodes. And the spiral accelerates. Ray Dalio explained this exact mechanism in his February 2025 CNBC interview. He said, there won't be a default. The central bank will come in and will print the money. That sentence right there is everything you need to understand. Because printing money to pay debt doesn't make the debt go away. It just transfers the cost from the government to you. Through inflation. Through currency devaluation. Through the quiet, invisible erosion of your purchasing power. Now, everything I just said, that's the problem. But here's the part that actually matters. While this spiral has been building, something else has been happening. Something the smart money noticed years ago. And it's playing out right now in ways that are impossible to ignore. Gold surpassed $4,000 per ounce for the first time in October 2025. 4,000. 5 years ago, gold was trading at 1,800. 10 years ago, it was 1,200. The run-up hasn't been steady. It's been explosive, especially in the last 3 years. And when you dig into who's been buying, the picture gets very clear very fast. Central banks bought over 1,000 tons of gold annually for 3 consecutive years. 2022, 2023, 2024, 1,000 tons every year. That's not speculation. That's not retail investors buying coins. That's nations, governments. the institutions that control monetary policy. And they're not buying gold because they think it's pretty. They're buying it because they're hedging against the exact spiral Dalio is warning about. Poland now holds 28% of its reserves in gold and is targeting 30%. Let that sink in. Poland looked at the global monetary system, looked at the dollar, looked at the euro, and decided that nearly 1/3 of their national reserves should be in a metal, not bonds, not currency. Metal. China has reported 13 consecutive months of gold purchases. 13 months in a row. The People's Bank of China is not known for making emotional decisions. They're making a strategic bet. And the bet is that gold will hold value better than the alternatives. According to the World Gold Council's 2025 annual report, 95% of central banks surveyed expect global gold reserves to increase in the next 12 months. 95%. That's not a trend. That's a consensus. The people who manage the money that backs your money are moving into gold at a pace we haven't seen since the 1970s. Now, I know what you're thinking. Okay, but I'm not a central bank. I don't have billions to move around. What does this mean for me? And that's exactly the question Dalio answered. And his answer is going to surprise you. Dalio recommends allocating 10 to 15% of your portfolio to gold or Bitcoin as a hedge against currency devaluation. 10 to 15%, not 1%. Not a speculative side bet. A core allocation. And here's why. Because if he's right and the government prints its way out of this debt spiral, your dollars will lose value. Not over decades, over years, maybe months. And gold, historically, is the asset that holds its value when currencies collapse. Look at what gold did in 2025. 67% return. The S&P 500, which had a great year by any standard, returned 17.9%. That's a gap of 49 percentage points. That gap is telling you something. It's telling you that investors, the big institutional players, are moving capital out of risk assets and into safety. And gold is the definition of safety in a currency crisis. But here's the thing most people miss. It's not just about the return, it's about what the return represents. Gold doesn't produce anything. It doesn't pay dividends. It doesn't grow. So when gold goes up 67% in a year, it's not because gold got better. It's because the dollar got worse. That 67% return is actually a 67% loss in confidence in fiat currency, and that loss of confidence is accelerating. The dollar has weakened over 10% against major currencies in 2025, 10% in 1 year. That might not sound like much, but compounded, it's devastating. If you're holding cash, if you're in bonds, if your retirement account is in dollar-denominated assets, you just lost 10% of your purchasing power before you even account for inflation. And inflation, using real numbers, not the official CPI, is running even hotter. What I'm about to show you next is the thing that took me years to understand. And it's the thing that changes how you think about money entirely. Because this isn't just about gold. This is about what's happening to the dollar as the global reserve currency. And that shift is going to reshape everything. For 70 years, the dollar has been the world's reserve currency. That means when countries trade with each other, they trade in dollars. When central banks hold reserves, they hold dollars. When commodities get priced, they get priced in dollars. That system, the petrodollar system, the Bretton Woods legacy, has given the United States an extraordinary privilege. We can print money, and the world has to accept it, because they need dollars to trade. But that system is breaking, not collapsing overnight, but cracking, slowly. Then, all at once, 12 countries dropped the US dollar as their primary reserve currency this year. No announcement, no press conference, just a footnote in an International Monetary Fund report. But that footnote represents a tectonic shift. Because once the dollar loses reserve status, the United States loses the ability to export its inflation, which means the inflation stays here. And it gets worse. China is building an alternative payment system. It's called CIPS, the Cross-Border Interbank Payment System. Russia is using it. Iran is using it. Saudi Arabia is experimenting with it. And every country that uses CIPS is a country that doesn't need dollars. The BRICS nations, Brazil, Russia, India, China, South Africa, they're openly discussing a commodity-backed currency, not as a fantasy, as a plan. And if they pull it off, the dollar's role as the dominant global currency is over. This is what Dalio means when he talks about capital wars. It's not tanks and missiles, it's payment rails and reserve currencies. And the United States is losing. Not because we're weak, but because we're drowning in debt and everyone knows it. So, here's where we are. The US is borrowing to pay interest. The dollar is weakening. Central banks are buying gold at record levels. Alternative payment systems are being built to bypass the dollar entirely. And retail investors, the people watching this video, are still being told to stay in 60/40 portfolios and trust the system. The Congressional Budget Office projects a $1.9 trillion deficit in 2025. $1.9 trillion in a single year. And that's the optimistic projection. If interest rates stay elevated, if a recession hits, if any number of variables go wrong, that deficit explodes, and the spiral accelerates. And at some point, the market says, we're not lending to you anymore. Not at these rates, not with this much risk. And that's when the printing press turns on, and that's when your dollars become worth less. Not worthless, worth less. Every month, every year. Until you wake up one day and realize your savings bought you a life, and now they buy you a vacation. We're halfway through, and honestly, the best stuff is still coming. Because now that you understand the problem, now that you see the spiral, we need to talk about what you actually do. And that's where it gets interesting. Because Dalio is not the only one talking about this. JP Morgan's Global Commodities Research, the World Gold Council, RBC Wealth Management, they're all saying the same thing. And the answer is simpler than you think. Gold is effectively the second largest reserve asset in the world right now. Not officially. The IMF still counts dollars and euros and yen as the primary reserves. But functionally, when you look at what central banks are actually holding and what they're actually buying, gold is the safety net. And that tells you everything you need to know about where this is going. Let's talk mechanics. How does this actually affect you? Because it's not abstract. It's your grocery bill. It's your rent. It's the price of everything you buy. When the government prints money to pay its debts, that new money enters the economy. More money chasing the same goods. That's inflation. And inflation is a hidden tax. You don't see it on your paycheck, but you feel it every time you swipe your card. A gallon of milk costs more. A tank of gas costs more. A house costs more. But your paycheck doesn't. That gap, that's the tax. That's the government transferring the cost of their debt onto you. Gold protects against that because gold can't be printed. There's a finite amount of it. When the money supply expands, gold's value relative to that money goes up. It's not that gold becomes more valuable. It's that the currency becomes less valuable. And gold, being scarce, reflects that loss. This is why central banks are buying. They're not betting on gold. They're betting against fiat currency, against the dollar, against the euro, against every piece of paper that can be printed into oblivion. And if the central banks are betting that way, maybe you should pay attention. Now here's where people get tripped up. They hear buy gold and they think, okay, I'll buy some gold coins and put them in a safe, and that's fine. Physical gold has value, but Dalio's recommendation includes Bitcoin, and that's interesting, because Bitcoin and gold serve the same function. They're both scarce. They're both outside the traditional financial system. They're both hedges against currency devaluation. But Bitcoin has something gold doesn't: portability, divisibility, and a younger demographic that believes in it. I'm not here to tell you Bitcoin is better than gold or gold is better than Bitcoin. I'm here to tell you that the smartest investors in the world are allocating 10 to 15% of their portfolios to assets that can't be printed. And whether that's gold, Bitcoin, or a mix of both, the principle is the same. You're protecting yourself against the devaluation of fiat currency. Let me give you the numbers again because they matter. Gold returned 67% in 2025. The S&P 500 returned 17.9%. If you had 10% of your portfolio in gold, that allocation alone would have added almost 7% to your total return. And that's in a year where the stock market did well. Imagine what happens in a year where the stock market doesn't do well, where a recession hits, where the debt spiral becomes impossible to ignore. Gold doesn't just protect you, it performs. But here's the part that nobody talks about, the psychological part. The part that actually determines whether you win or lose. Because you can know all of this, you can understand the mechanics, you can see the data, and you can still do nothing. And that's the most dangerous position of all. There's a reason most people don't own gold. It's not because they don't understand the value, it's because it feels weird. It feels like prepping, it feels like you're betting against your own country. And that emotional resistance is powerful. But here's the thing, you're not betting against your country. You're protecting yourself against bad policy. There's a difference. The government doesn't care about your retirement account. They care about managing the debt. And if managing the debt means printing money, they'll print money. And your savings will be the collateral damage. So the question isn't, should I buy gold? The The question is, why haven't I bought gold yet? What's stopping me? Fear of looking paranoid? Fear of being wrong? Fear of missing out on stock market gains? Let me reframe it. If you allocate 10% to gold and nothing happens, you're fine. Your other 90% keeps working. But if you allocate 0% to gold and Dalio is right, you lose. You lose big. That's asymmetric risk. The downside of not owning gold is catastrophic. The downside of owning gold is negligible. So why wouldn't you own it? Now let me tie all of this together, because when you see how these pieces connect, everything changes. The debt spiral creates currency devaluation. Currency devaluation drives investors into hard assets. Gold and Bitcoin are the primary hard assets outside the system. Central banks are buying because they see the spiral. Retail investors aren't buying because they're still listening to advisors who are trapped in the old paradigm. And the gap between what institutions are doing and what retail is doing is the opportunity, or the warning, depending on how you look at it. Ray Dalio said the resolution to this debt crisis is simple. The central bank will print the money. That's not speculation, that's a guarantee. And when they print, your dollars lose value. Not might lose value, will lose value. The only question is how much, and how fast. The Congressional Budget Office says interest payments now exceed defense spending. Think about that. We're spending more to service our debt than we are to defend the country. And that ratio is getting worse. Every year. Every month. At some point, the math becomes impossible. And the only way out is inflation. Controlled inflation if we're lucky. Hyperinflation if we're not. Gold hit $4,000 per ounce in 2025. Some analysts are projecting $5,000 by the end of 2026. Some are projecting higher. I don't know where it's going. Nobody does. But I know that the conditions that drove it to 4,000 are still in place. The debt is still growing. The dollar is still weakening. Central banks are still buying. And that means the trend is intact. Here's what you need to understand. This isn't a prediction. This is a response. Central banks aren't predicting that fiat currency will collapse. They're responding to the possibility. And their response is to move into gold. You can do the same thing. 10 to 15% of your portfolio. Not as a speculation, as a hedge, as insurance. Because if Dalio's right and the spiral continues, that 10% could be the difference between maintaining your purchasing power and watching it evaporate. We're in the home stretch now, and I've saved something important for the end. Because this isn't just about gold, this is about how you think about money, about wealth, about the future. For the last 50 years, the financial advice has been simple. Save in dollars, invest in stocks and bonds, trust the system, and for 50 years that worked. Because the system was stable, the dollar was strong, debt was manageable. But that era is over. And the people still giving that advice are living in the past. They're giving you a playbook that worked for their generation and assuming it will work for yours. It won't. The world is changing, not slowly, rapidly. And the investors who recognize that, who adapt, who move capital into assets that hold value outside the system, those are the people who will preserve wealth. The people who don't, who stay loyal to a system that's failing, they're going to pay a steep price. Dalio's allocation recommendation, 10 to 15% in gold or Bitcoin, isn't radical, it's prudent. It's what any rational investor would do when looking at the debt levels, the deficit projections, the currency devaluation, and the central bank behavior. It's not a bet, it's a hedge. And in a world where the downside is currency collapse, a hedge is the smartest move you can make. Poland is targeting 30% of reserves in gold. 30. They're not doing that because they're paranoid. They're doing that because they ran the numbers. They looked at the European debt crisis. They looked at the dollar's trajectory. And they said, we need to be in hard assets. And if a country can make that decision, so can you. Your future self is going to look back at this moment, at this video, at this decision point. And they're either going to thank you for paying attention and taking action, or they're going to wonder why you saw the warning signs and did nothing. The information is here. The data is clear. The smart money is moving. The only question is whether you move with it. Before I go, I want to know, what's the next topic you want me to dig into? Central bank policy? Bitcoin versus gold? The mechanics of hyperinflation? Drop it in the comments. This channel exists because you keep watching and engaging, and I want to cover what actually matters to you. You're not pushing that boulder uphill anymore. You're building a system where your wealth is protected regardless of what the government does. That's the shift. From hoping the system works to building a plan that works even if the system doesn't. And gold, Bitcoin, hard assets, that's the foundation. The rest is just details. Your future millionaire self is counting on you to see the spiral for what it is and to act before it's too late. Don't let them down.